for more on this and how it could impact the bond market, I'm joined in the studio by Jim Stening from FIIG Securities. Jim, great to have you in. Thank you. Obviously, we don't need to say it again, but a surprise decision. Where do you think that sentiment from the RBA is coming from? Do you think they're getting phone calls and having meetings with other central bankers around the world who are just saying, hold off, we don't want you to stick your neck out too far at the moment?
Yeah, well, I mean, I don't want to indulge in conspiracy theories, but I think reading the statement yesterday, it could have ended in a sentence raising the official rate. It was quite a hawkish statement.
Yes.
So, you know,
very similar to the December one where they did raise.
That's right. And so, you know, looking at all the sectors of the economy, as far as the statistics go, it is moving ahead, and in some cases moving ahead quite solidly. If you look at, say, house prices, I mean, that was a surprise on the upside. So, stepping back and looking at it, I think, you know, fundamentally there is a missing piece to the jigsaw. I think, you know, you know, in the old days I used to refer to the Reserve Bank as Granny, and I think in this case Granny knows best. So yeah, I mean, I tend to think also that. So
you wouldn't say you disagree then, or you're just being kind?
Well, no, I do think that one of the things that's emerging, and it was very briefly mentioned in their statement, and obviously central banks have to be very careful when they're talking about these subjects, and that is that there's starting to be a bit of an unravelling in the sovereign debt market. So those are things that I think are fundamental to a recovery over the long term, and I think that given the G20 countries are sort of moving more in unison these days, there's certainly consultation and conversations that are going on that may have highlighted that as an emerging threat to stability. So, you know, for me, I think that was probably the issue that stayed the RBA's hand.
So, sovereign debt issues, obviously, that's coming out of Europe. But I guess we like to think we're a little bit removed and we'll focus on China. But
well, that's right. I mean, I think, look, the issue is that the crisis has moved, the leverage has moved, or the bailout of the private sector was conducted by the public sector. So the question you ask yourself is, well, who's going to bail out the public sector?
Yes.
And so, you know, obviously the larger economies are heavily involved in that. I think that then you take a step back and say, which of the sovereign issuers are too big to fail? So who will be saved and how will they be saved? And I think, you know, it's really problematic, absent a US recovery, if the US has to contribute to the bailout of other countries, as the European economies have to, well, that affects their own budgetary position, which, you know, absent a recovery with high levels of unemployment, is a problematic thing for them to manage.
Do you doubt the recovery in the US?
I think it's a very difficult position. I think, you know, we saw a statement from Moody's last night that the AAA rating of US debt could be under threat over time, given their current spend. And I think so. The recovery is something that needs to occur. It's difficult to stimulate the economy without fiscal stimulus, without increasing the budget deficit. So rates have to stay low. Yeah, I think it's crucial to global recovery. So
the RBA decision, obviously we now scale back the idea about the pace at which it will move. Obviously we still expect it to move higher though. Do you predict many more rate hikes to come? Or where?
Yeah, well, I thought, you know, the statement, going back to the statement again from the RBA, it's a bit of a Clayton's tightening. You know, it's the tightening you have when you don't have a tightening. I mean, yeah. I've never really seen them be so transparent in terms of the overall direction of rates. I mean, they are going up according to the RBA. So I think, you know, what will unfold, things like inflation will determine the ultimate level of official rates, as will access to credit markets. But I think we can safely say that we'll you know, the likelihood of a further increase, given the current statistics that are coming through, is pretty high.
Okay, so putting that RBA decision and statement to the side, obviously with this issue of sovereign risk, central banks are watching that, as you said, but what about the bond markets and how that's going to affect the bond markets in the short and
well, that's key. I mean, I suppose we've seen a little bit of move out in credit spreads, but, you know, with the recovery, a little bit of a bounce in equity markets, that's stabilised. I mean, last night we saw these the Portuguese issuing bonds. The tender wasn't that successful. They didn't sell all that they wanted to. These are cracks that are a little bit of a concern. So
we haven't seen that really in the US though yet.
No, we haven't. I mean, obviously we're talking about lower rated sovereign issuers, but I suppose as far as that market goes, there's continued concern. I mean, we haven't sort of made a top in terms of the credit default swap or the credit spreads in those sovereign issuers.
And what about the opportunities that you see emerging amongst all of that and this developing issue for investors?
Yeah. Look, I think there are going to be some great opportunities, depending on how this plays out. But I mean, again, it comes back to that that assessment, which sovereign issuer is too big to fail. So there could be some very cheap sovereign debt on offer around the world over coming months.
Okay, and Australian investors, are you finding interest from them in getting on board any of this?
Well, Australians are a little bit reluctant to look at offshore markets absent the top end of town.
So how do we access all of this? How do Australian investors get in on the story and find opportunities?
Well, I mean, it's difficult. I mean, you can contact a fixed income broker, but
I know one. So
yeah, look, you know, there are ways that people can gain access to it. Really, you need to be well informed, obviously.
Yeah. And can I quickly ask you about the Australian dollar? Obviously back towards 88 US cents. Is it going to jump up pretty quickly again? Is it just a blip, or where do you see it?
You know, I mean, obviously the bias is tightening. Again, you know, if our economy continues to perform, things settle down, rates will go up. The interest rate differentials will widen. There's been a lot said about the move in the currency from 90 down to 88. And when in the scheme of things, I mean, in previous sell-offs, it's really it's nothing. You know,
it can jump 1.5 cents in a night.
Well, that's right. I think last time the carry trade was unwound, we saw a massive gyration of over 20–25% in terms of the sell-off in the currency. So the fact that it's held in there, I think that there's still believers globally and domestically in that trade.
Jim, we have to go. I've been told, because I've been told to wrap up. So we thank you very much for your time. We'll chat soon. Thank you.